Good afternoon and welcome to a closer look at the CPF Real Estate Credit Fund. My name is Joe Christie and I'm joined today by one of our portfolio managers, Xander Ryan. The presentation will take about 10 or 15 minutes and I'm going to hand over to Xander, who's just going to go through a disclaimer and also give an introduction to today's agenda.
Thank you, Joe. And thank you for joining our webinar. I'll just start with a quick disclaimer. So the returns that we talk about today, they're not guaranteed and they're subject to the performance of the underlying asset. And Joe or myself are not registered to give financial advice or licensed to give financial advice. So what are we going to cover today? Most of you are aware, but we're just going to do a quick introduction to capital property funds and introduce the team. I'll get Joe to do that. And then we'll just do a few differences between the debt fund and the credit fund. Most of our investors are familiar with the debt fund, but the credit fund's a new fund that we've released in the last year and a bit. And we're just trying to get everyone up to speed with what some of the benefits of that are. So then after we've gone through some of the differences, we're just going to look at kind of 5 key benefits of the credit fund that we think they are. We'll just have a question and answer after that. So if there's any questions about the credit fund, we'll answer those. And then we've got a new loan coming out called Obanvale, and that'll be a land subdivision. And this holding will be a position in the credit fund. And we thought we'd just highlight the opportunity. It's a video with Noah and Joe and the sponsor of the project. So that'll be at the end for about 10 minutes. So you can either tune in or tune out for that. And that'll be on our YouTube channel if you wanted to watch that at a later date. I'll now pass over to Joe to introduce the CPF team.
Yeah, thank you, Xander. So this is the team that was taken. This photo was taken probably about 3 months ago, and the team has grown a little bit since then. So we are growing, but you can see that we have an investor relations team. So I normally do this by standing in front of the photo, but we've got an investor relations team. And we've also got a fund accounting team. So the fund accounting team are responsible for paying distributions, maintaining compliance with loan agreements, sending borrowers monthly loan statements, etc. We've also got an events management and marketing team. And then we've also, at the big chap at the back that with the beard, he runs our development management team. So most of our loans, or most if not all of our loans, have a condition in the loan agreement where our development management team, particularly where there's a construction program, must attend the site monthly to attend the PCG meetings, manage the construction program, or help assist the management of the construction program and construction drawdowns. We've also then got our portfolio managers being Xander Ryan, who's sitting next to me, and Noah Morabito, who are responsible for originating lending opportunities, and then they get presented to the investment committee. And sitting on the investment committee is Rod Moynihan, our head of development management, myself and Andrew Kerr. And so that's basically the team.
Yeah, the team's growing. There's this photo. There's a few people that probably need a new photo to update everything. But it's a good team, a growing team, and feel free. You can always talk to any member of the team and reach out. So we thought we'd just provide that so all the investors know who's on the other side of the phone. We'll just start with the kind of differences between the debt and the credit fund. So most of you are aware the debt fund, you pick and choose the opportunities. So if you really like industrial developments, you could have gone into Tingaupa, which was an opportunity last year. And once, for example, that opportunity is complete, for example, Tingaupa, those funds will be repaid to your bank account, or they'll be put in cash units. And those cash units will earn the cash rate. That's currently 4.2% on our cash units. And the debt fund, active management might be a stretch, but when the loan is finished, there will be, what do you want to do with the money? Do you want to reinvest it in another industrial opportunity? Do you want to sit in cash? What do you want to do with it? There are also some of our loans like Spring Creek Stage 6, where there might be partial repayments when the loan's settling down. So you might get half the loan back at the start of the month and then half the loan back at the end of the month. So there's some a bit more management with the debt fund. And then when I compare that to the credit fund, your capital is continuously deployed, so there's no cash drag. Once an opportunity in the credit fund finishes, you just automatically rolled over, and those positions in the credit fund can change. So currently there's 24 loans in the credit fund. So instead of picking and choosing one loan in the debt fund, you've got a pool of 24 loans. So you've got that diversification. And then finally that set and forget. So when the credit fund's indefinite. So when you want to take your money out, you can. There's 2 redemption windows, but you don't have to worry about one loan finishing and then going into the next loan. Joe, would you like to add anything to that?
Yeah, look, I think you've summarised it quite well. Is it's a new fund for us, but the big thing is that you're continuously invested, and your funds are always earning, so there's no cash drag, and you're getting exposure to a really broad portfolio of loans. So I think that's a really good summary.
Yeah, and we'll talk more about some of those points.
Oh, and so the other thing I will add, sorry to come back, is that look, it's targeting 9%, but it's paying around about 10%. So the returns are quite good.
Yeah,
in the credit fund.
That's a very good point. I'll just echo those points. So the real estate credit fund, that is a fund that targets 9%. And in the first quarter this year, from January 1st to March 31st, it paid a return to investors of a 10% annualized return. And we expect that strong performance to continue. So whereas with the debt fund, the opportunity you pick, if it's a 10% return, you'll get that through till the opportunity finishes. Where with the credit fund, you might see a bit of variability. It could, if the fund's performing extremely well, it could go to 10.5, or if cash rates move down, it could go to 9.75. So there's a little bit more variability in the credit fund. But yeah, no, that's a very key point that we didn't mention. So I'll just talk about what we think are 5 key benefits. I'll quickly go through the 5, and then we'll expand on every point. And Joe, please feel free to add anything that I miss. So the first one, it's always invested. There's no, you're not going from an opportunity to cash to another opportunity, so you're not missing out on that return. There's 2 liquidity windows, and I think that's a big point. So with the debt fund, most of you will be aware that if you go into an opportunity, you're in that opportunity until the project is complete and sold down, or it's refinanced. So you need some sort of event to happen for your money to be returned. Whereas with the credit fund, it's based on a calendar system, which we'll talk about. You've got that diversified exposure. So instead of going into one opportunity, a dollar into the credit fund goes into 24. So that's quite powerful and strong. That set and forget, less paperwork that we talked about. And then something that we've recently introduced is the compounding effect, or reinvesting your distributions. And we'll just talk about a simple example of $100,000 and what that can kind of build into a position into the credit fund. So I'll start with always invested. So when I briefly talked about this, but when you go into an opportunity, one that's just repaid is Paddington. So that repaid on the 8th or 9th of May, and investors in that class could go to cash units. They could get their units redeemed to their bank account, or they could wait for the next opportunity. So we have quite a few investors in that loan, and quite a few just chose to wait in cash and wait for the next opportunity. They might be looking for a higher rate return, maybe 11% in Toowoomba or Toralba, or they're just waiting for another opportunity like Rochedale or Obanvale. So there's all sorts of things you can do when your money's returned. But while it is sitting in that cash, it is earning that kind of reduced rate of 4.2%. And why that's important is the sticker. If let's say you got repaid in Paddington at the start of this month, and you waited till the end of the month to go on a high return like Toralba, that month you've lost in interest can really affect your total return. So that's why we just want to talk about that day one deployment. You're not going from an opportunity to cash to another opportunity. The other thing is no cash drag, fully deployed. And the credit fund is always open for investment. So no matter when funds are returned, there is always those windows that you can invest. Anything you'd like to add there, Joe?
Look, I think now you make a really good point. Is we haven't actually done the analysis, but I think by the time being fully invested all the time, earning that 10% return, if you compared that to sitting in cash for a month or two, probably your overall return's about the same.
Yeah,
So
slightly less.
without all the administration issues. So first point, you're always invested, which I think is a strong point.
Oh, good. The next point is those liquidity windows. So the real estate credit fund has two redemption windows, the 15th of March and the 15th of September. So it's two biannual redemption opportunities. You do have to give notice for that redemption. But just why that's an important factor is with the opportunities, most of them are about 12-month opportunities. Most of our investors will be aware of that, but sometimes it rains in Queensland or there's an issue with titling. So sometimes that 12 months can be pushed to 14 months, or the project could go extremely well and it could be repaid in 10 months. So there is a bit of variability about when funds will be returned to investors if you go into an individual opportunity. With the credit fund, it's got those two redemption windows, which can relieve a bit of cash flow if you were going into an opportunity and needed some funds out. The credit fund can be that place for you. Whereas with the debt fund, once you're in there, we could do everything we could, but you're normally locked in for that period. So it's just something quite a strong benefit. That extra liquidity can be quite useful.
Absolutely.
The third thing I want to talk about, and this is quite a large point, is the diversified exposure. So if you look on the right of the screen, we've got the portfolio allocation by asset class. This is just as currently as today. So the credit fund has 39% of its funds in townhouse projects. We do have quite a few townhouse projects. We've got the Junction, Bowral, the Foundry. So we do have quite a large exposure to that. And that's why the credit fund is weighted quite strongly to that sector. We think it's quite a strong sector. But you can see the weightings: 39% for townhouses, 17% for land, 15% for commercial. It's got quite a large cash holding at the moment of 15%. The reason for that is that we've got two opportunities that'll be settling, actually three opportunities, that'll be settling at the end of this month. And the credit fund will be taking a position in those opportunities. So that's why it's got slightly more cash at the moment, and then that cash will be redeployed. So we try to aim for about a 7%. That's kind of that sweet spot of between 5 to 10. And then you've got childcare at 9%, and then land subdivisions. That was slightly high, but stage 6 has just been repaid, or is had a significant repayment, and we'll be looking to increase that when we go into stages 9, 10, 11, which will be coming out shortly. So that was kind of the asset allocation. And then what we really like about it is you're not putting your eggs in all the one basket. So it's not the one developer, it's not the same asset class, and it's multiple locations across predominantly. A lot of the book is in Queensland, but there are more and more opportunities coming to New South Wales, like Obanvale, Teralba, Minto, Bowral. Exactly. So there is, we are, exactly. We're trying to start that geographical diversification along as the asset class and borrowers. So we think that's quite powerful. Again, there's nothing wrong with picking and choosing. I do it personally, but some people don't. You can just pick and choose the opportunities you like, or you can put $1 in it and get that great exposure. Would you like to add anything there, James?
No, look, I think you've covered it quite well. Is that I think that it'd be difficult to build that diversified exposure doing individual loans, because you put the money in here and you get that great automatic diversification. So if you've only got $50,000, it would be impossible to spread $50,000 across all those loans. Whereas you can put 50,000 or 100,000, you're getting exposure that you wouldn't otherwise have available for a smaller capital application.
And that's a very good point. We'll talk about it in the next slide, in the next topic, which is set and forget. And that point about a lot of our investors make their own credit fund. Quite a few of them, they just go in first mortgages, and they've got the exposure across the portfolio. And there is nothing wrong with that, and we encourage that diversification. It's not an issue, but there is a lot of paperwork that can come along with that. If you're in 24 different loans, that's a mixture of first and second. One's expiring almost every month or every couple of weeks, or you're getting a repayment of capital. So it can be quite a lot to stay on top of. You've got 24 different holding statements, a few tax statements as well. So and you might be on holidays and Paddington repaid at the start of this month. Some of our investors, haven't got back to us because they're on holidays, they're dealing with the grandkids, they're busy with life because life is busy, and that simplicity of just getting that credit fund made for yourself can be quite attractive to some people, and why I think the credit fund, as Paddington's finished, as Tingalpa's finished, those quite larger loans, people have got to know us, and they're looking for that kind of set and forget, and yeah. So a few other things is there's that the passive structure. You just got to sit back. You don't have to worry about which loans expiring when. So that's quite important. And then obviously we have quite a we've got the investment committee where we analyze each loan. We provide updates on each loan. So we kind of you are giving over the keys to CPF, so to speak. But we're doing that due diligence on all the loans we put through. I guess, and another thing is on that less paperwork and simplicity. Joe, we provide a monthly update. So Joe and I record every month an update on the portfolio. We also record YouTube videos of site updates. So last month, I think we did updates on the Junction, the Foundry, Taringa, and a few other loans. These are all available on our YouTube channel. So you can really stay up to date with the portfolio and still just have a holding in the credit fund and see what your funds are doing. So yeah, anything to add?
Yeah, well, just on that, you get an informal video every month.
Yeah.
You then get a formal fund update every quarter.
Yeah.
And I really like coming back to what you're saying about, you get one tax statement and you get one transaction statement and one holding statement at the end of each year. So it simplifies your paperwork and it gives you that diversified exposure. So I think there's a big tick there for set and forget.
Yeah, and I missed it when I was talking about the fund update. So distribution for the credit fund, like the debt fund, is quarterly. And each quarter, starting last quarter, we provide a fund sheet. So that says what the average LVR was, a breakdown similar to what that what the loan was exposed to, some of the highlights. So I'll just quickly talk to last quarter's update. There was Tingalpa, so Tingalpa fully repaid in that. So the credit fund got a bit of a cash injection. Spring Creek this quarter, Spring Creek Stage 6 repaid, is repaying. Paddington repaid. So every quarter there's movements in the credit fund. There's allocations shifting around due to projects completing. And we'd like to just give a little snapshot of what happened. And you can always ask for more information. The credit fund is having significant growth at this stage. I think we ended last quarter about 10 million, we're about 15 now. So it's getting quite large, and we want to provide more and more information, and keep everyone up to date. So that's why we really like the set and forget. And if you've got anything further, you can always ask us about the set and forget. And then the final thing, I'll let Joe speak to this more, but we've just enabled reinvesting distributions, and it's quite a powerful tool for building a position in CPF. Joe, do you want to talk through the reinvesting distribution?
Yes, thank you. And it was actually something driven by Xander and our portfolio managers, is that really to be full, it should be the compounding effect of reinvesting distribution. So the real estate credit fund now offers investors the opportunity to either fully reinvest their distributions or partially reinvest their distributions. And if you aren't familiar with the compounding effect, the analogy here is that you put in $100,000, and assuming that the fund continues to pay 10%, in the first year you'll get $10,000 in income, and if you reinvest that, then in year 2 you've got $110,000, and then it earns $11,000, and so on and so forth. And you can see by about year 6 or year 7, your $100,000 has become almost $200,000. So there's two things to really be aware of, is that you get a compounding effect of your capital. So I think if somebody said to me, give me your $100,000 and in 7 years I'll grow that to $200,000, I'd say, well, where do I sign? I think it's a wonderful feature. And then as the capital grows, so does your income. So if at year 7, your capital has gone from $100,000 to $200,000 approximately, therefore your income has gone from $10,000 to $20,000. And I think by year 10, you're more than $250,000 purely from that compounding effect. So your capital has gone from 100,000 to over 250,000. I think it's closer to 270,000. And also too, that means that your income has more than, not quite tripled, but close to nearly tripling in value. So I just think it's not going to suit everybody, but it's a great little option if you don't need to live on that income. And some of the investors are in that accumulation phase. It's a great little option for the real estate credit fund.
Yeah, and if you were, we've got a lot of people in the credit fund who aren't aware of this tool. There is simply a form you can reinvest all your distributions, or you can do it in part. And I'll just go back to this graph. This graph assumes we pay distributions every quarter, so it's your distributions reinvested every quarter. And this doesn't take into account tax or other things like that. So yes, you do need to keep that in mind, that there would be tax paid on your distributions. That's not for us to talk about, but just to keep it in mind. But it is quite powerful if you were looking to build a position. So yeah, that's it. And then you can see how your interest grows quite strongly over that period. Well, that was a 20-minute snapshot on the credit fund. We do like to, we provide that quarterly fund sheet. So there's always information there. If anyone had any questions on the credit fund, feel free to put them in the Q&A tab at the top of your screen, and Joe and I, we can do our best to answer them now. You can always give Joe, myself, or any member of the team a call to talk about the credit fund, or any of the debt opportunities as well. That we're not, there's both still open. And we really look forward to hearing from investors in cash units, or if they're looking to simplify their holdings with CPF. I'll just have a quick look at the Q&A tab and see if anything was there. If you say there was one about how do I activate reinvestment. So feel free to reach out to the team. We've got a form that it's quite a simple one-page form. You just want to you can do a partial or full repayment of partial or full reinvestment, and then you just submit that, and then that'll happen, and we'll put that in the system. So
it's a simple one-page form. Just tick a few boxes and sign it.
And you can always change your mind on that. That's once you sign it, it's not set in stone forever. I'll just
have a question. Someone's asked about the management fee. That's a good question. The returns are, just to clarify, the returns are a net of all fees and expenses, and the fund takes a performance fee. So anything over the target return, which is 9%, we take 25% of that return. And I think the management fee
is 1.5%.
Yeah, 1.5%. Yeah, 1.5%.
So yeah, just on that, the credit fund, that's something that we've just recently introduced for the kind of founding people in the credit fund. The credit fund was paying 9%, and we thought that it was in everyone's best interest to kind of give CPF that incentive to try and beat that target return. And the first quarter we look forward to continually trying to beat it. And that kind of one of the reasons for that is that we want to make the credit fund the flagship fund for CPF. So we'll start putting, all the opportunities are good, but the best opportunities into the credit fund to maximize that return for investors. So that's a great question. Thank you for asking that.
Okay. We've also asked a question about there's 24 loans at present, but what is then in the pipeline?
Yeah.
And what return percentage did you use on the graph to reinvest? So,
2 minutes. Yeah. So for the loans in the pipeline, we've got 3 settling this Friday. We've got 2 industrial developments. So that's one at Riverview in Queensland and one at Rochdale. So that the credit fund will be taking positions in those. We've also got a land subdivision that after this Q&A we'll play a video on. It's called Obanvale in New South Wales. So the credit fund will be taking a position in that. Apart from that, we always there is as
pretty much every month.
Yeah, every month there's a new opportunity. At the start of next month, there'll be one in Margate, Queensland. It's 4 townhouses. So we have quite a strong pipeline of opportunities coming through. And with all our development opportunities, let's say Joe was a developer and he wanted to build a townhouse. We don't just go, hi Joe, here's $1 million, go build the townhouse. We release money on a cost to complete basis. So kind of there's always money that can be raised to give to Joe or other developers to put those funds to work. So that's that pipeline question. And then for the return, that was a 10% annualized return. So for that, and we're happy to provide that.
There's a quiz cluster, one down below. Just
how do you allocate investment on the true form? How's it? So the question was, how do you allocate an investment among the 24 individual loans? We kind of do it in a way that every loan size is different. So we're settling one in Rochedale this Friday, and that's about a $15 million loan. So the credit fund might take $1 million position or higher, but then we've got some smaller loans that might be $2 million, and the credit fund might take a $200,000 position. So we try and structure where we allow debt investors to get in, but also have a holding in the credit fund. So it's not 1 to 24th weighted or anything like that.
Yeah, it's a very good question about the allocations. We actually don't have a target portfolio weighting to a particular asset class or region, but there is an internal guide. So you can see, looking at that portfolio weighting, we are relatively heavy towards residential housing stock, being townhouses, because and also land as well. Is effectively we've got 39 plus 17, so nearly 50% of the portfolio really weighted towards residential housing stock. And the reason we do that is the way we read the tea leaves is that residential properties, there's an insatiable demand for the finished product, so we're quite bullish on residential property. That question, it's not 1/24th. We are sort of trying to build the portfolio with targeted ratings that we have an internal review probably every quarter at the lending committee.
And then I'll just jump in there. So part of that 39%, there's Taralba and there's the Junction. So Taralba will be finishing around September this year, so 2 or 3 months away, and then the Junction will be in October. So we're going to have that townhouse exposure will decrease as those funds repay. So we kind of try and allocate where funds are maturing, so we have that kind of constant turnover. And then currently we have no industrial developments. We quite like industrial. That's why we're doing Rochedale and Riverview. So this time at the end of the next quarter, there'll be an industrial position, probably around 10% of the portfolio we're looking to add. So yeah, thank you for that question.
And we do publish that on a quarterly basis. We're getting quite a few questions here. Somebody asked a question about, are the loans insured against default? There's no the primary recourse or security against the loans that we're property based a fund, and so we take a major recourse is against the underlying asset, and there's no insurance, etc. So we want to make sure we have a really good qualified independent valuer who has valued the land, and that we lend to an appropriate LVR against that, or loan to valuation ratio.
And can I just add in there the weighted the average weighted LVR for the credit fund last quarter was 66.96%. So that kind of gives you a bit of an indication of what your risk spectrum or what the risk is. So there are, the fund has a cash position. It's predominantly first mortgage investments, and then there are a few second mortgages to increase that to provide that
sweeter yield.
Sweeter yield for investors.
I'll answer this one if you like. Is that somebody's asked about the taxation implications of the income. Now, we're not licensed or qualified to provide taxation advice, but from our limited understanding is that all distributions from the fund are classified as interest income. So there's no franking credits or capital gains tax exemptions. It's purely income.
Mhm. Well, that was. If there's any further questions, we'll just wait another 30 seconds. But no, thank you so much for listening to Joe and I speak about the credit fund. It's something that we're really looking to grow, and we're looking to provide investors that opportunity. We've just now got. Actually, I'll just quickly skip ahead to how to create an account, and then we'll go to a video. So. If you were interested, if you're a new investor that's listening to our seminar or webinar, sorry, you can go to our website. You'll see here new account, new investor application. That'll take you to a page that looks like this. We can we can cater for any sorts of accounts. So you can do an individual, joint, sole trader, company, super fund, trust. And then you just follow those steps that are on the script when you're going through those and create the account. You can always call any member of the team if you were looking for assistance with an account setup. And I just wanted to highlight, was our social media. So this is our YouTube page. I need to get a more updated screenshot because this is, I think that says March, the March update. We're now onto May, so that's uploaded to the YouTube channel. And we've got a few new, the Junction video, the Foundry, etc. And there's also our Facebook page where we also provide updates to investors. So if you were looking to, follow the progression of loans, you can do that there. We just had two. I'll just quickly go back to so that's about how to create an account. We just had two more questions. The credit fund is currently $15 million. We have had quite a bit of growth, and we have, for investors that are aware, we just had Paddington repay, and there are quite a few investors with cash units. So those cash units, we've seen quite a strong, probably 8 out of 10 people have been moving to the credit fund just for that simplicity. So there's still, we think, quite a lot of growth, and we're looking to make that kind of the flagship fund.
Yeah, it is growing. Yeah, like it's really hitting its strap. We think it'll be probably at 20 million by the end of this financial year, which is only a month away. Yeah. And it's growing quite quickly.
Yeah, and just on that, just to put it in comparison, the debt book, so the one where you pick and choose, that's about 180 million, and the credit fund's 15. So it's still a small growing fund at CPF, and we look to grow that further. I'll just.
Look, it's a good question. Somebody asked, will we cap the credit fund? We do have the opportunity to, it's a very good question. Look, probably we have more opportunities. Someone asked about the pipeline. There's a lot of lending opportunities at the moment. At this stage, we haven't thought of capping the credit fund, but probably, if it got to 500 to $1 billion, we'd probably start thinking about whether we cap that fund. But certainly we've got the expertise and the experience to manage funds of several $100 million. And what I thought that we might look at capping it at $500 million to $1 billion. But at this stage, we're certainly not looking at capping the size of the credit fund.
Mm-hmm. Well, I'll just quickly say it again. Thank you all for coming to listen to Joe and myself. We've now got about I think it's an 11-minute video about Obanvale, one of the opportunities that will be slotting into the credit fund. It's a video with Joe, Noah, another portfolio manager, and the actual sponsor. So we'll play this video now. We'll stay on so we can answer any questions if anyone's got them after the video. It's about 11 minutes. Feel free to watch it, or you can tune out now if you didn't want to watch the video. But we'll be around at the end to answer any questions about Obanvale, or if you had any further questions on the credit fund, we'll be there to answer them. So enjoy the little video, and we'll come back in about 11 minutes.
Welcome, investors. Today we're here with the sponsor of our Obanvale opportunity, Michael McCrudden. I'm also joined here with Joe Christie, and we're just going to do a little quick 5-10 minute chat just to get some quick questions that you investors might have. And I'll let Joe kick off. So,
thank you, Noah. Michael, welcome to the CPF webinar. I've got a couple of questions I wanted to just go through with you, but can you just give us a thumbnail sketch of your background in terms of what you've been doing with Reward Homes and just generally what you've been doing in the Singleton area?
Okay, well, I've been in the building game for over many years. We started a building company in 2008, and since then we started our own projects. We got an opportunity down at what they call the Ponds in Sydney. That really started off. We picked up 5 acres there. Then we got the next door neighbour. We got 10 acres. We're a family business that wanted to be in control of our own destiny, if you may, because we wanted to provide mum and dads and first home buyers with product. We were one of the very first full turnkey products as well with our home and land packages. We since we did that 90 home and land packages, we went to Box Hill that did another 70 home and land packages. And they got another one with the Gables behind there. They've wanted us to build for them. We've had since I progressed in Sydney, we're starting to think, the product was starting to get too expensive for the mum and dads and the first home buyers and all the investors as well. When you're looking at $1,000 a lot, $1 million a lot of a land, it was just getting silly. So we eventually had a look around and we come across a few opportunities in the Hunter region. We did a couple of small home and land packages there, 3-lot subdivisions and 5-lot subdivisions. And then we felt that the market was shifting a little bit more as well, was getting more expensive. So we decided to go a little bit further out of town. So we ended up at Singleton. We got 2 opportunities there. Mm-hmm. We already got one under construction at the moment in Hunterview, which is approximately about 5 k's away from the Obanvale site, which we're currently talking about. We've got 90% sold in before we even turned to it. So yeah, well, the affordability is the key for those areas. Are you talking 3-4 to maximum $400,000 a lot? When I thought that was very appealing. You're getting your product for under 800k still, but they are creeping up now because of the home costs and the extra taxes. Won't go there, but yeah, so it's creeping up a little bit. So under 800k, you can still get a home and land package, and that's what we're trying to deliver. We're trying to look after the market. We've got a record now of delivering in the Singleton area. We've got a rapport with the council and the local trades and the civil contractor that we've engaged. We've already engaged him to come across to Obanvale, very keen to do so. Yeah, we just thought it was a great opportunity to deliver a product that's affordable. 40 minutes away from Newcastle by a great expressway. They got a new bypass going in at Singleton now. The beauty of where we're at is there's an increase of population going on there at the moment with the mines. They put a guideline that you have to work within 10 kilometres of the mine, so that encourages more growth there. You got the new hospital getting built there, and there's a lot of other stuff going on in the Singleton area. It's a nice growth area. The site itself, you can't get a better site. It's picturesque. It's got river running through it. Have parks, wildlife at your doorstep. Great place to bring up a family and create a community. And we love the site. As soon as we walked on the site, I said, I've got to have this. It's so good. Rolling hills and just so good. And so we want to deliver a similar product there. We look after mums and dads and first home buyers. Great for investments there with dual living homes and dual occupancy, because the high rentals in the area, or low rentals in the area, I should say. There's nothing to rent in the area. It's currently 0.3%. It's very low. You can't get a decent home in Singleton at the moment. But we're very happy with the product that we're going to deliver there.
Yeah.
All our sites will be benched. We are very, very conscious of your mum and dad getting the block they can build a house on. So we make sure all the services are there and do all the tick the boxes for the mum and dads and investors to get a nice product.
Michael, mate, there's so many interesting things to talk about. Just sorry, no to interrupt, but I just love so much of what you're saying there. I'm just going to unpack some of that stuff.
Sure.
I love you've got a planning track record. So you mentioned that you've got a relationship with Singleton Council. So you've got a track record of delivering this style of product previously with the council. You've got the same civil contracting crew coming over. But what I want to talk about is the market that you're targeting. I just love the fact that you're targeting that affordable end of the marketplace. So you've got mum and dad can come in and buy a beautiful piece of block of land. I want to talk about that. And it's a lovely place to bring up a family. And for $700,000 or $800,000, and your proximity, you've got proximity to schools, sporting facilities.
Correct.
You can get into town, shopping centres, all that. Dad can go to work in Newcastle. Mum can drop into shops in Singleton. So I love all that, and it is a beautiful piece of land. Noah and I both walked it. You've got river frontage. You've got bush. The kids could run out and get lost in the bush. Having fun. I just love it, and all for sort of 300,000 or 400,000. I want to just talk about also. Can you tell me just the expressions of interest you've had? I think stage one is approximately
40 sites.
40 commitments on it at the moment. I don't put them on to sale until the DA comes out. We're expecting the DA to come out the end of next month.
Yeah.
We've got to sit with the planning committee. They tell me we've got a shortage of houses in New South Wales, but they don't believe it. It's so slow, the process. It just does my head in some of the things that they say and we've got to do. But you do them and you get it done. That's what we're about. We want to get it done. We want to move on and go to the next one. But this side is probably the pick of the bunch that I've ever done. The beauty of it is it's the last one in the area that can be built. So you've definitely got a reserve on the one side. You got a little bit of a break between the other project that was there. So it sits in its own little nest egg, and it's really, really picturesque. Can't rate it highly enough.
I can't echo those comments enough. It is a beautiful piece of land. I just also want to just touch on just the Hunter generally, because we've got investors from all around Australia. You mentioned there, it's a diversified economy. You've got proximity to Newcastle, which has got its own economy. You've got the winery region, which promotes tourism. You've got the mines. You've got teaching hospitals. You've got a very large equestrian industry. Probably. A world-class leading equestrian industry.
Well, Muswell's only 20 minutes away, or 40 minutes away at max, and that's one of the big breeding companies for the racing industry. It's very good.
And probably world-class. I don't know a lot about horse racing, but I know that it's a world-class breeding centre, the Hunter Valley, and they get good prices. So it's a really, really diversified economy. You've got the mines, obviously. I think Newcastle is the largest coal loading port in the world, and that's not going to go away tomorrow. I think it's very strong. And as you said, the roads are getting better. It's not really that far from Sydney. So what a lovely place to bring up a family. I think I tilt my hat to you, and we like that affordability too, because there's always more buyers at that affordable end of the marketplace. So we really like that. It just ticks so many boxes for us. Look, I think, Mike, you really gave a great introduction. You've covered all the main points. Is there anything that we've missed, Noah?
I just wanted to move on to next steps. So after this DA is received, you briefly mentioned before your civil works to start on site. So when are you expecting to get the civil works starting on site? I think
when you get the RFIs from the council, there's pretty bit more reporting to be done and boxes to tick. That process will be done externally. We're going to a private certifier instead of council. Council they don't have the resources at the moment to see it through. They take a long time. We've been told 3 months we could start turning dirt there.
The next sort of
Yeah. Yeah.
Okay.
So we're hoping to turn dirt by the end of the year.
And we've seen it before with some of these loans, like councils can be slow, but there'll always be like provisions for that and time adherence to that. And we'll look to move that process through swiftly.
But we have, just on that point, we have made a provision in the loan for the planning approval based on external advice from planning. So I think, there's a lot to like about this particular opportunity. Michael, unless Noel's got anything else, we're so grateful for your time. That was a great introduction. Thank you for the opportunity to chat with you. And we look forward to walking with
nice
you
to
in the
chat with you
future.
guys too.
Yeah, we look forward to
and thank
funding
you for
next
your
stages.
support as well.
Yeah,
And
right. Enjoy the rest of the day.
all
Thank you,
all
Michael.
your
Thank you.
customers. Take care.
Take care.
Let's go back to this. So thank you for all that. Watch that video. So that was with one of our new. It's a new sponsor, new project. We're really looking forward to it. We've kind of referred to it as a second Spring Creek, so to speak, in New South Wales. So we're quite looking forward to settling that. Michael, the sponsor, did touch on it. That project doesn't have its development application approved yet, but it's been lodged. We've taken external advice and we've provisioned time in the loan for them to get that and all the other relevant approvals. So if there were any questions on Obanvale, feel free to call any member of the team, or you can ask them in the chat now. But if there aren't any further questions, thank you so much for attending the webinar. Thank you for watching the video with us. And we really look forward to hearing from new and old investors about
and also to thank you, Xander, but our marketing team will send out a copy of the presentation to all attendees. So thank you again. Thank you for your continued support and enjoy the rest of the day.